Ladies and gentlemen, while I know the last few months have been a bit rocky for Tesla, and you know, I don't think a lot of you guys would have questioned this video as much as you would have on December 12th or December 18th, December 17th, when Tesla was at all-time highs. You would have said, yeah, this seems kind of likely. And what that is my price target for Tesla stock. By the end of this year, I think Tesla is going to be a $900 stock with a potential path to $1,000 or even higher. And I will explain a little bit more in depth where my price target is coming from. I'm not just pulling this out of thin air. There is some numbers to go behind this, but it does also depend on the Fed, to some extent Doge, and how much they're able to cut from government spending, if that drives down 10-year treasury yields the way that I think it will. So I think that's also kind of a variable of this price target. Okay, you need to see certain things happen to get to $900 per share by the end of this year. In this video, I will also share with you kind of the more, I don't want to say worst case, but like super reasonable case. And trust me, it's a lot higher than where the stock is today. It's almost a double from here. And I think that's more super reasonable. So we have a lot of work to do in a very short amount of time. I'll try to give you the information you need without rambling too much. If you appreciate that, hit the like button as well as subscribe to the channel. For every one of you guys that subscribe to this channel, you help push these videos out to more people that can learn about Tesla and learn what's going on. Because let's be honest, if you read the headlines right now, you think Tesla is a disaster because what happened in January. I mean, you think like Tesla is really slowing down. You think that Elon Musk is driving away all of Tesla's potential customers. I mean, you think Tesla doesn't have a CEO right now. Of course, if you read the headlines. And the more people that see videos like this, the more people can be educated, and, well, potentially the better Tesla will do longer term. More people educated, more people with solid, sound information, the better reasonably the stock should do longer term. Keep in mind, I'm not a financial advisor. I'm not a financial planner. I could be totally wrong. The stock could crash. The stock market could crash. We could have a depression this year in the polar severity of potential outcomes. So keep that in mind. And with that, let's get started. If you guys have been a viewer of this channel for a while, you know I take in a lot of information. All I do, I barely listen to music. I really just watch everything. Every CNBC clip that is posted, every Bloomberg clip that is posted, every Charles Schwab clip that is posted, and also just other different YouTubers, if you will. I hate that word, but YouTubers, if you will. I take in everyone's opinions. And I think that's where kind of my strong suit comes in the broader market sense, okay? Because a lot of the time, I could tell you things before they happen. And that just comes from having so much different opinions. It really allows you to formulate a great opinion of your own. Now, I usually don't share a bunch of clips on this channel. But in this video, I'm going to share one of them in particular. Because when narratives get so concise and so just the same, okay, when everyone's talking about the same thing, the same outcome for this year, stocks are going to do well and the Fed's going to cut rates once, maybe they pause for this entire year, like that is so consensus. I found a clip that is so far from that consensus, it's valuable. Because let's be honest, we all know the consensus. That's not valuable to sit here and listen to that over and over and over again. You really always want to find someone or something that challenges your opinions. As if you're super bullish, you really shouldn't seek out bullish opinions. You should seek out the bearish opinions. You should seek out the people that do not believe what you believe. because that's where you help formulate better opinions for yourself. And we're going to start with this clip. It's from Warren Pies. He actually expects the Fed's going to cut rates 3 or 4 times this year, that the economy could start to materially weaken around April, May or so. He also expects that disinflation will come a lot more rapidly than expected. Some of this I agree with. I agree we're going to get more than the one cut that's priced in by markets. 3, 4, 5, 6, depending on what happens with the economy. Now, be careful what you wish for, because if we're talking 5, 6 cuts, the economy's probably not in a great place, and that's not going to be a good kind of dynamic for markets. Okay, and there's other aspects that I don't necessarily agree with, but are worth mentioning. So first, before we get into my opinions, take a listen to this clip from Warren Pies on CNBC yesterday.
A bigger breakout could be in the cards, but I see here that you took your weighting to stocks down a bit. Am I reading that right?
You are, yeah. So we were running an excess long position, and we just neutralized that last week. And so I think the bottom line is it's too early to outright worry, but you need to start looking ahead to some potential risks in this market. And like you said, the market's been in a really tight range. It's 6% plus or minus for the last 3 months. Really, if you go back historically since 1950, this tight of a range only occurs about 13% of the time. And you really need to be patient and watch where the market breaks. And our view is we're going to break out to the upside in the very near term, which is positive. But when we get out to spring, I think you need to start taking some precautions when we get out to spring.
Why are you overweight bonds?
I just don't see. Number one, I think disinflation is going to bite pretty hard this year, and I think that the gist of our concerns out in April are growth concerns, and so I think for the first time in a while, bonds are providing a really nice diversification benefit for your portfolio. You know, I see the consensus. It comes on TV and just out in the financial news in general, and they're saying, you know, no cuts this year. The Fed's going to be on hold all year. I don't think the economy can handle that. I think that the housing market at 7+% mortgage rates doesn't really work, and we're going to see that. Really, it's going to be about April, May when I think those cards are kind of flipped over, and we can see that clearly.
What role are tariffs going to play in all that?
I don't think so. Our view is not that tariffs themselves are a major problem for the economy or the market or for inflation even. But what I see, the major impact that tariffs are going to have is on the Fed. So, you know, if we look at last year and this year, you know, we just had this hot inflation report. I think if you dig through it, it's not that bad. We had a very similar residual seasonality last year, the first 3 months of the year, hot inflation. The Fed was very quick to calm everybody down and say, we want to look through this. It was an election year. The Fed was much more prone to cutting last year. I think that the role tariffs plays is it gives the Fed a potential excuse or at least a reason to be less reactive to inflation. So when we go out into April, May, say, why are you so concerned April, May? We have that March Fed meeting. I think that tariffs and the threat of tariffs at that point in time are really going to cause the Fed to continue on this hawkish pattern. And they're going to be doing that at a time where the economy is slowing. Tax receipts are coming in strong. Whenever you have a strong bull market year in the preceding calendar year and you go forward in it's time to pay the tax man, that's usually a weak period for the stock market. So I think all those things come together around April, right after that Fed meeting. So tariffs, I don't see them as a threat in and of themselves. I see them causing the Fed to be more hawkish, though.
More hawkish. But eventually, though, it sounds like you think they're going to have to act. I mean, if the economy is going to slow more dramatically than maybe some people think, and I mean, you're thinking about Doge also, right? If you're going to cut spending that dramatically, you're thinking about growth taking a hit as a result. So a more hawkish Fed turns into a more cutting Fed, though.
Yeah, I mean, like right now, I'd say if you look at the futures market, there's like one cut priced in, and in Fed SEP is like 2 cuts priced in for the year. I think we're going to take the over on that. So I think we're going to have 3 or 4 cuts still this year. And it's really just a matter of how painful it's going to be to get there. You know, if the Fed wants to stay really what we're calling a recalcitrant Fed, if the Fed wants to stay combative or recalcitrant, then I think it's going to be a tough time for the markets. But ultimately, one way or another, I do think we're going to get cuts. They might not come till the back half of the year, but I'm taking the over. That's part of why we want to be overweight bonds here. I think the Fed cuts 3 times, if not 4, this year.
You want to be overweight or market weight on tech? I mean, there's a pretty good debate, I think, to that question being asked right now.
I want to be overweight personally. I look at this, the growth scary. And so part of deciding what to be overweight is looking out and not making mistakes. And so I want to have interest rate sensitivity in my portfolio. So maybe utilities, interest rate sensitive stocks like that. And I think large cap tech, they've trailed the market here. We've had a broadening out, but ultimately, if the market's going to break out and really you want to be bullish, then I think those are going to have to be the leaders still. And I think I have a hard time. You look at where earnings are supposed to come from. You see the big role that semis play, NVIDIA plays. Those have to be the leaders. If we're going to have double-digit earnings, which I think we will, it's going to have to come from the tech sector still. And so, to me, I want to be overweight tech. It has some defensive characteristics given the growth concerns. I want to be underweight resource stocks in this environment. So I want to be underweight energy. I want to be underweight miners and things like that outside of gold, and stay sort of defensive in my weightings within the market.
I actually agree with a lot of what he says. To still be constructive in markets, still likes tech, right? Overweight to bonds. I think some of that makes sense. Just how sold off bonds are, and when you look at TLT, you can see that. I believe I have it pulled up on one of these charts. Yeah, TLT. It's so beaten down and really has been for a while that, that could make sense. And basically what that's saying is 10-year treasury yields are going to continue to come down. And I agree with that. The one thing that I really don't agree with is that the Fed is going to be behind the curve when it comes to the economy weakening. I don't agree with that. Now, it's hard to know for sure. History would say the Fed would probably be behind the curve, but Trump is the president. I don't think the last thing Powell or anyone at the Fed wants is for more questioning of Fed independence, by the Fed being behind the curve again. Late to start raising rates, late to start cutting rates and supporting the economy. It's the last thing Powell wants. So from that perspective, as long as the economic pain is not too much, and as long as the Fed does not continue to kind of be a hawk in spite of the economy weakening, stocks will do well under that paradigm, okay? As 10-year treasury yields come down, that induces a much more risk-on environment for markets. Again, the question is, recession or not? Here's the deal, though. The Atlanta Fed GDP Now tracker is tracking Q1 GDP at 2.3%. This is a big drop from the 2.9% we had previously. This comes from retail sales, business inventories, exports, and imports data. Okay, we've seen a big drop on Friday, down to 2.3%. If we continue to see this fall, and estimates for GDP continue to come down, the Fed will respond, and the Fed will be more bullish. And I don't think the Fed's going to be late to that. So while, when the economy starts to slow, when jobs markets start to slow, you could get a moment of temporary panic until the Fed acts, okay? But the Fed will act. And normally when the Fed is accommodative, markets do well. Usually we don't just walk into recessions. The last time we walked into a recession without anything like being a central catalyst, I believe was the 1980s. Okay, you've never walked into a recession without a catalyst, meaning dot-com bubble. Well, that was the catalyst. The bubble burst, had a recession. 2008, housing crisis. You didn't just walk into that. There was a focal point that burst, that blew up, that caused a recession. COVID. It was COVID, lockdown, artificial recession. Boom. The last 3 recessions we've had have been situations where we don't just walk into a recession. And what walking into recession really means is without any big catalyst or ignition event, just month by month continues to go on, GDP continues to weaken, jobs market continues to weaken. That just doesn't happen these days. It just doesn't happen. So if we enter into a lower growth environment, a more choppy environment with a more accommodative Fed, with lower 10-year treasury yields, do you know where that benefits most? Well, it benefits most, you could argue, small caps. Tech, an area like Tesla that is highly, I don't want to say levered, but kind of levered to interest rates, right? Consumers and cars. As long as you don't have mass unemployment, then that's a very good dynamic for Tesla. Accommodative Fed, lower interest rates, lower economic growth, like say GDP at 1%, 1.5%. Lower than the 3% we've been at in the last 2 years, but not recessionary. That would be a very bullish outcome this year for Tesla, and really for our markets as a whole. And that's part of the expectation that I have for this year. As I have also said previously here on this channel for a long time now, is I believe AI appliers, like AI software names, real world AI appliers like Tesla's, FSD, and Optimus, is the next kind of wave of hype, but actual utility. It's kind of like the internet, okay? Internet providers, they really didn't do that well. Maybe at first, right? When the internet first came around, people started using it, AI, internet kind of applications or enablers, if you will, of internet probably did very well. I don't even think I have to go verify that, but providers of internet probably did well at first. But the real winners became the second derivatives of the internet, became the Metas, it became the Amazons, okay? It became the things that were built on top of the new technology. And Tesla is the number one AI stock by far on our markets, by a long shot. The number one applier of AI. And I think as treasury yields come down, the Fed becomes more accommodative. It becomes cheaper to get a Tesla. Tesla's really going to benefit from that. And especially we have the robotaxi launch in June. Wall Street's going to actually start seeing Tesla's AI live in person. Now, Tesla is not going to be the only stock that excels here, but it's going to be one of the ones that Wall Street really loves the most, because there's one aspect about Tesla is no matter what your age is, Tesla offers a way to capture potentially extreme upside without the added risk of a small cap, without some of the other risks that you would have in a company not as large as Tesla. So I think a lot more people and funds can allocate to Tesla. And I think that will happen over the remainder of this year. Now, as Warren Pai said, we can have some kind of correction or fear moment, spring, late spring, early summer. That's what, you should expect this year, at least 10% drawdown. But I do believe it will lead to a much larger rally for Tesla, as long as things go right. As long as we launch the robotaxi network in June, as long as Optimus continues on its trajectory for some production by the end of this year, Wall Street's really going to take notice, and the stock will be rewarded for it. Now, as Canaccord Genuity's analyst said earlier today, if you have not seen that video, go ahead and check it out. Canaccord Genuity takes a $10 EPS target for 2027 and puts a 40 times multiple on it. Now, this is based on where rates are today, where treasury yields are today. So as treasury yields come down, as 2021, right? Everyone bid up non-profitable stocks, zombie companies, high because you really couldn't get a risk-free yield from treasuries. So it creates more of a risk on environment for markets. So even with the restrictiveness that we have today, they still give it a 40 times multiple for 2027. I would argue this $10 EPS target for 2027 could probably rise to $12 of expected EPS by 2027, full year 2027, with a multiple that could be in the 65 to 80 range. I think that is a lot more likely to me as long as things play out. Okay, as long as Scott Bessent, Trump, and Elon continue to cut costs at the government level, continue to reduce the deficit and reduce waste. Okay, this to me seems like more of a logical, reasonable kind of price target by the end of this year if you want it to be a little bit more conservative. Now, you could also say $12 of expected EPS by 2027 because I do think earnings expectations for Tesla will go higher in the second half of this year as Tesla really starts to operate robotaxi. Like, how would they not go higher? That's a stupid thing to say, right? And $12 might be a low ball. Maybe earnings estimates for 2027 go to $15 per share. I don't know. The question is really the multiple. And am I being too conservative here? Earnings estimates could go up 50% by 2027 as Tesla launches the robotaxi network if it's successful, and as Tesla says, launches the robotaxi network in multiple other cities. You could see $15 of expected EPS by 2027. Because as Elon Musk says, that's where things are going to get pretty insane for Tesla. But we'll stick with $12. If you put an 80 times multiple on that, you're looking at $960 per share. That is not unreasonable, in my opinion. Now, if you put a current market multiple on that, which Tesla trades at about 120 times, that's $1,400 per share. That's where you get into that would have to be the best possible case scenario for Tesla. Like Tesla exceeds all expectations, a rapid deployment of robotaxi in Austin. Weeks later, you get a rapid launch in multiple other cities, like rapid fire robotaxi launch. Then you could be looking at something like this. But, I wouldn't hold my hat to that. I think $12 of EPS by 2027 times 65 to 80 multiple is pretty appropriate. Call it 75. You're looking at exactly $900. Oh, wow. How did I get to that number? That's crazy. Right? That's my price target by the end of this year. So there is a way for the numbers to actually make sense here. Okay? Because earnings estimates are about $10 for 2027, and Wall Street's at about a 40 times multiple on that today. If you could almost double that multiple to 35 as interest rates come down, as deregulation picks up, as Tesla shows that they are actually, doing what they say as far as launching robotaxi network and launching in other cities this year, I think it's easy you could get to $900 this year. As long as there's no recession or as long as the Fed is not so far behind the curve that, there's more recession fears. You don't even necessarily have to see a recession. Just fears of a recession can be enough to materially drive down markets like we had in 2022, right? Everyone kind of thought we were heading into a recession. That recession did not materialize, so the bear market ended. But you still had like a 30% drawdown. So that's where I get this $900 price target by the end of this year. Earnings estimates going from $10 to $12, which I don't think is unreasonable at all, and the multiple going from 40 to 75. It's also very possible earnings estimates could go to $15 per share of EPS by full year 2027, times like a 60 multiple. That still gets you at $900 per share. So it really depends what the trajectory of earnings estimates are. And as Gianca said in the clip yesterday, it really just depends if Tesla executes. If Tesla executes, they bring these lower, cheaper priced Teslas to the mass market. They continue their progress on Optimus. They launch robotaxi in Austin. But again, I would add they launch robotaxi in other markets as well. Elon said robotaxi could launch in multiple markets this year. And, well, if that happens, that's going to be great. And that's really going to reward Tesla stock. And that's why I think Tesla in the 350s is insane to me. People are really just not paying attention to Tesla. They're letting the fear get the best of them. And here on this channel, I'll at least call it for what it is, say it for what it is. None of this recent news, Elon and all the drama going on, has any impact to Tesla. I would argue Elon taking a more right-wing approach to politics these days might actually be more of a positive to Tesla than not, because you're opening up conservatives to now buy electric. I don't know. Call me crazy, but I think if you are already an owner of a Tesla and you want to stay electric, there's not too many other options out there. But hey, especially not options that are better than Tesla. There's none for that matter. So let me know what you guys think about this information down below in the comment section. Just really sharing my thoughts, kind of my perspective around this. I wanted to clarify a little bit on my $900 price target by this year. It's really not that extreme. As long as, 10-year treasury yields come down. Let's say 10-year treasury yields come down to like 3%, even 3.5%, 3% or so, roughly where they were as the Fed cut rates the first time. Like we were just at 3.62% September of 2024. You could potentially see even lower rates than that, 3.5%, like we were in May of 2023, or in April 5th of 2023, you were at 3.28%. You could see rates down there in the second half of this year. And if that happens, you're really going to see Tesla benefit. So yeah. Hopefully this makes some sense. Let me know what you guys think down below in the comment section. And for that reason, I'll continue to be bullish on Tesla until Tesla fails or something goes wrong. I think the discount from $488 down to $350 is really just sentiment. It has nothing to do with anything else. And that is a big reason. Again, I will reiterate, just 1 second, sweetheart. The short interest of free float is at all-time lows in Tesla. It's never been lower than where it is today. There's a reason for that. And the option activity, even again on Friday, was very positive. 85% positive order value. Hedge funds and institutions, they're not scared of Tesla. They're running headfirst into Tesla. It feels like more retail investors have panicked a little bit recently. And just a little exercise for you guys that are making it to the end of this video. Look at the comment section of this video. If people are super bearish or super bullish, I think that's going to tell you all you need to know about sentiment. Normally, you want to be a contrarian. So if there's a lot of negative sentiment on this, the comment section of this video, that is more of a reinforcing sign for the bulls. Okay? If people are super bullish, well, I doubt that's going to be the case because, yeah, these days you say anything good about Tesla, it is nothing but ridicule. So, ladies and gentlemen, let me know what you guys think about this information down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.